Right now, every single person in the UK has a £20,000 allowance that lets them earn money completely tax-free. No income tax on the interest, no capital gains tax on the growth, no tax on dividends. £20,000 sheltered from the taxman every single year. And in 3 weeks, that allowance resets to zero. Whatever you have not used by April the 5th, 2026 is gone. You cannot roll it over. You cannot save it for later. It simply disappears. Most people will do nothing. They will let the deadline pass, lose the allowance, and not even realize what they gave up. By the end of this video, you will know exactly what an ISA is, why this deadline matters more than any before it, and what to actually do with your money before the clock runs out. So let us start with the basics. ISA stands for Individual Savings Account. From here on, I will just call it an ISA. It is a wrapper. Think of it like a container you put your money inside. The money itself can be cash sitting in a savings account, or it can be investments like stocks, bonds, and funds. The wrapper does not change what is inside. What it does is make everything inside it invisible to the taxman. Any interest you earn inside an ISA, tax-free. Any profit you make from investments going up in value, tax-free, and any dividends paid to you by companies you own shares in is also tax-free. Outside an ISA, you pay tax on all of those things. Inside an ISA, you pay nothing. Now here is the part most beginners miss. You get a fresh £20,000 allowance every tax year. The UK tax year runs from April the 6th to April the 5th the following year. That means the current tax year ends on April the 5th, 2026, in 3 weeks. And whatever portion of that £20,000 you have not used vanishes. It does not carry forward. It does not stack. April the 6th arrives and you start again from zero with a new 20,000. Think of it like annual leave at work. Use it or lose it. But this year, there is something different. Something most people have not heard about yet. The government announced in the autumn budget that from April 2027, if you're under 65, you will only be allowed to put £12,000 into a cash ISA each year. That is a 40% cut to your cash ISA allowance. The total ISA allowance stays at 20,000, but the government is capping how much of it you can keep in cash. They want you to put the rest into stocks and shares. That means this tax year and next tax year are the last 2 years where you can put the full 20,000 into a cash ISA if you're under 65. After that, the door closes. Permanently. So what should you actually do before April the 5th? There are 4 types of ISA cash stocks and shares: lifetime and innovative finance. You can split your 20,000 across as many of these as you want, as long as the total does not go over 20,000 in one tax year. If you are a complete beginner and you have never opened an ISA, before the simplest first step is a cash ISA. It works exactly like a normal savings account. You put money in, it earns interest. The difference is that the interest is tax-free. You can open one with most banks and building societies in about 10 minutes online. If you are following along and finding this helpful, hit that like button and hit subscribe. I've got more videos just like this on the way. Now, if you already have some savings set aside and you will not need the money for at least 5 years, a stocks and shares ISA gives you more growth potential. You are not picking individual stocks. Most beginners put their money into an index fund, which is a single investment that automatically spreads your money across hundreds of companies. The value goes up and down in the short term, but over long periods the stock market has historically grown faster than cash savings. The key rule is this: cash ISA for money you might need soon. Stocks and shares ISA for money you can leave alone for 5 years or more. And here is a new rule that most people do not know about yet. Since April 2024, you can now open multiple ISA accounts of the same type in the same tax year. Before that, you were limited to one cash ISA per year. That restriction is gone. So you could put 10,000 in a fixed rate cash ISA for the better interest rate, and another 5,000 in an easy access cash ISA for flexibility. Both in the same tax year, both completely legal. The only rule that still applies is the 20,000 total cap across all of them. So here is what matters right now. 3 weeks. That is all you have left of this tax year. If you have not used any of your £20,000 allowance, you are about to lose it. Even putting in £100 is better than putting in nothing, because once April the 6th arrives, that window is closed forever for this tax year. And remember, next year is the last year under 65s can use the full 20,000 in a cash ISA before the cap drops to 12,000. That means the next 3 weeks and the following 12 months are the most valuable ISA window you will get for the foreseeable future. Open an account, put something in, even a small amount. The best time to start was years ago. The second best time is before April the 5th. The question you should be asking yourself right now is not whether you can afford to put money into an ISA. It is whether you can afford to keep letting this allowance disappear year after year while the government quietly makes it smaller. If you found this video helpful, please remember to like and subscribe. It allows the channel to grow and for me to be able to help more people on their investing journey. Thanks for watching.